Hi, everyone, and thank you for joining us for today's webinar, Secure Act 2.0, Employer Implications and How to Prepare. And if you haven't been with us before, welcome. I want to just go over a few notes for you for this presentation. All participants will be placed on mute during this presentation, but during the Q&A section, feel free to unmute yourself to ask questions. You can also submit them through the question function in the webinar app. This webinar is being recorded. The recording and slide deck will be sent out within a few days. CPE credit is available to attendees who answer all 4 poll questions scattered throughout the presentation. If you are looking to get CPE, you must answer all 4 polls to be eligible. If you qualify, the CPE certificates will be sent to you via email within the next few weeks. There will be a survey that appears on your screen at the end of this webinar. Your feedback is very important to us, and we want to provide you with as much value as possible through these webinars. If you would take just a few minutes to fill that out, we would greatly appreciate it. For those of you who may not be familiar with Richey May, we were founded almost 40 years ago, exclusively to focus on the needs of the mortgage banking industry. This singular focus from our experts enables us to help lenders accomplish their goals. Our experts believe in the forward progress and success of the industry and dedicate much of their time to teaching through webinars like this and building others through the MBA School of Mortgage Banking and at other industry conferences and associations. And with that, I'd love to turn it over to today's presenters. Katie, can you kick us off?
We are excited to have you listening to our Richey May webinar today. Again, this is Secure Act 2.0, Employer Implications and How to Prepare. I'm Katie Compton, Assurance Partner at Richey May, and also the lead Assurance Partner for the Employee Benefit niche. We are pleased to have Patrick Blanchard, Managing Director of Compensation and Benefits at Alvarez & Marsal, and Michael Schmidt is also a Director of Compensation and Benefits at Alvarez & Marsal. They'll be joining us online to share the latest developments in Secure 2.0 and why it's important for you as plan fiduciaries. We want to thank Alvarez & Marsal for partnering with us. We find their firm to be a great resource for our clients as they listen to our clients' problems and provide practical solutions with expertise in law, tax, and consulting. Thank you both for joining us today, and I'm going to turn this over to Michael to start the presentation.
I'll let Patrick jump in, and we can go from there.
Thank you. And thanks, Katie. We always appreciate partnering with Richey May on these. Like you said, we're a global consulting firm. We have almost 9,000 employees worldwide. We always like to get that out there. The joke is a lot of times that we're the largest consulting firm nobody's ever heard of, which is somewhat by design. Like you said, Michael and I both practice in the compensation and benefits space, and particularly specialize on qualified retirement plans. So Secure 2.0 is right in our wheelhouse. We like to bring the practical aspect of compliance and administration to our clients, and that's how we differentiate ourselves, even though both Michael and I are attorneys by background, which usually people say, don't hold that against me. I always say, feel free to hold it against us. As long as we don't prove that you should look at us otherwise. So Michael, you want to kind of jump in on Secure 2.0 and what we're looking at here?
Yeah, absolutely. And just jumping in, we're going to start off with a quick poll question, just to gauge a little bit of information about the attendees. Looks like we're up and launched, but as you can see, the poll question is just trying to gauge a little bit of familiarity with Secure 2.0. Hopefully there's been at least a little familiarity generated there, but just trying to get a sense for where the attendees are at. We can kind of tailor the go forward based upon that. So, and go ahead.
Oh, sorry. Just want to remind everyone that this is our first poll question that we need answered to get CPE credit. It looks like we have almost the entire group in. I'll just wait a couple more seconds if you're out there. Okay, looks like I have it in, and now let's share the results. About 50% say they're familiar. 45, somewhat familiar, and 5%, we're best friends.
We got some experts here. It looks
Okay, so we are looking at the wrong version. If you can unshare your slide, there we
Yeah.
go.
away once I. Are we
There you
back?
go. Yep.
Yeah, we may have that same issue when the poll questions come up, so I'll keep an eye on that.
Okay.
All right, so I'll turn it over to Patrick just for a little bit of an overview on Secure 2.0.
Thank you, Michael. So Secure 2.0, to really understand what Secure 2.0 is, we have to start back in December 2019. December 2019, we got new legislation in the retirement plan industry. It was the most major legislation we'd received in over a decade. That retirement plan legislation was the Setting Every Community Up for Retirement Enhancement Act of 2019, and was shortened to Secure. Secure 1.0 really started to make some changes for the industry, and was helpful. That being said, there was a lot that could have gone in but got cut at the last second. And so as early as February of 2020, Congress started contemplating a Secure 2.0. Obviously, February 2020 was an interesting time to be starting any kind of conversation, because in March of 2020, everything changed. So when COVID happened, this was put on the side because we had all kinds of other legislation that needed to be passed, some of it related to retirement plans, and what kind of distribution options and emergency savings options would be allowed for because of the COVID pandemic and the liquidity concerns everybody had at the time. Ends up in December of 2022, they finally passed Secure 2.0 legislation. Secure 2.0 really is just a continuation of Secure 1.0, and kind of wanted to push the ball forward even more. The idea for both of those pieces of legislation was expanding the availability of retirement savings vehicles for employees throughout the US. So in Secure 2.0, we saw that took the form of expanded availability of those retirement plans to what we talk about as long-term part-time employees, which Mike will talk about. The idea that new plans will be required to implement an auto-enroll feature in their plans. So that's not forcing employees to enroll or defer into a 401k plan, but it significantly increases participation rates. So it's along those lines. And then also it included some tax credits intended to offset the 401k startup costs for small businesses and employer contributions. We generally focus on those first two bullets in these types of presentations, as well as some of the other issues that pop up in ongoing administration of plans and how that changed with Secure 2.0 rather than the tax credit. If anybody has any questions about the tax credit at the end of the presentation, feel free to ask them. So what does this look like from a timeline perspective? What we have here is the timeline of Secure 2.0. What you can see is that there were some changes in that middle top box that were updated for 2023, related to required minimum distributions, limitations on certain disclosure requirements, et cetera, et cetera, et cetera. Most of the changes, though, will be implemented in 2024 and 2025. So 2024, we have student loan matching, increasing cash out limits, RMD rules, the lost and found database, all of which we'll talk about in more detail later in the presentation. And then 2025, we have some long-term part-time eligibility rules, which that's when Secure 2.0 hit those, but 2024 included the Secure 1.0 rules. And then it included some ideas around auto enroll, increased catch up, stuff like that. Finally, For 8 months of 2022, the most prevalent topic we were talking about with Secure 2.0 was that starting 1/1/2024, catch-up contributions and 401k plans would be required to be made on a Roth basis for certain employees who were over compensation thresholds. This was an administrative nightmare. The payroll systems and the record keepers or administrators were all kind of pointing the finger at each other as to who was going to be responsible for that. And so it was just a lot of anxiety about how we were going to administer this. We were working through the administration process with some of our clients, and generally those clients were resigned to the fact that they were going to have to manually administer this. There wasn't going to be automation. It was going to be a drain on resources, stuff like that. Late August, the IRS and Treasury came out and actually delayed that Roth required catch-up for 2 years. And so that's what you'll see on that box to the far right. It was the 2-year delay was granted on August 25th. So now we don't have to worry about making Roth contributions for those catch-up employees until 1/1/2026. So and with that, Michael, do you want to kind of talk through the long-term part-times?
Absolutely, yeah. So just jumping in, and as Patrick mentioned, this specific item was something that was part of Secure 1.0. I always joke that I don't feel like it should be called Secure 2.0 because it's not technically the setting every community up for retirement equity, the second version of it, but that's just a nerdy lawyerly thing for me to point out and argue about. But this is an expansion and extension of what happened in 2019. So initially, when the first Secure comes out, there's a provision within it that says if an employee is not being permitted to enter a plan based on the minimum eligibility requirements, but that employee is consistently working on a part-time basis for the employer and working 500 hours each year, if that happens 3 consecutive years, the employee would be eligible to participate. So that's a I would say a departure from the normal or the original eligibility requirements, which would allow plans to hold out employees who hadn't met 1,000 hours of service. So it's bringing that threshold down. And the initial one says if you do it 3 years, then you get in. Secure 2.0 wanted to be even more accommodating and more generous with that and brought it down to 2 years, and they'd be eligible starting in 2025. And so the big question here is really, what does this mean? It's not a requirement that you have to automatically enroll your long-term part-time employees, so these people who are coming back and working 500 hours each year consistently. But it is a rule that you're having to allow them to be eligible. And there's a few important things to point out here. It's not a requirement that the plan sponsor or the company has to offer a matching contribution. It's the ability to defer that is the requirement here. And so where we saw the impact of this beyond the actual ability of the employees to defer is the data collection and the administrative, the hassle or cost of enrolling these employees. And so if you just think about it, the kind of manual nature of tracking some of the hours, if you're not doing that on a large scale, could be burdensome, and especially in some industries where there's a lot of coming and going, trying to track that can be difficult. So thinking about potential approaches to this, workarounds, certainly you can start tracking the hours. And honestly, if you're just starting now, you're a little bit behind the 8 ball because this is going back to Secure 1.0. But the tracking of hours is one approach. But you'll see here we have the insight that a lot of plan sponsors that we have been talking to have just created an eligibility condition to allow these employees to defer rather than having to track those hours. And it just makes it a little bit easier. And it's still something, the initial concern is there an additional cost, but you do not have to make them match eligible to comply with this. So just allowing them to defer their own money into the plan would satisfy these. So I don't know, Patrick, if you've run into anything else on this, but it seems like that's the direction that most have gone. But I know there's additional considerations that some people are seeing.
Yeah, the one place that we have seen some pushback on this is when you have a large kind of seasonal population or anything like that might come in, which that's what this was intended to cover. If you go with the immediate eligibility though, you might end up allowing in a lot of folks that would never become eligible, which from a deferral and employer contribution standpoint might be a non-issue because you can design around that. Where we have seen concern in those types of organizations is the required notices that must go to employees that are eligible. And so when you're thinking about letting them all in, thinking about what that process looks like to communicate with that group and what costs might be is very, very important.
All right. And so just following up on that, we wanted to show that there's a little bit of nuance, a little bit of complexity here. I'm not going to belabor the issue, but just showing on here, we have employees, various hours being worked, and the scenarios that would come of this. And in I guess, case 1 and 2, we're really trying to show the difference between the impact of Secure 1.0 and the timing of Secure 2.0. But essentially, in the first case, the individual would not have met the 3 years, but now with Secure 2.0, you can see that that person would then be eligible 1/1/2025 based on those 2 years of 2022 and 2023. And then similarly, the individual in employee 2 is actually working over 500 each of the 3 years, so eligible 1/1/24, also eligible 1/1/25. The final example, what we're trying to get at is if there is a condition for eligibility with a match or some sort of employer contribution. Once that employee gets over 1,000 hours, he or she would presumably be eligible there. So just trying to demonstrate that at that point, it's no longer a long-term part-time employee. This employee has met the regular standards for entry. Moving on to the kind of the second area where we're seeing a lot of traction, a lot of focus. The Secure 2.0 provides that new plans must include automatic enrollment after January 1st, 2025. And so a few things to focus on there. New plans. So if you have an existing plan, it does not apply to you. The second piece of that is January 1st, 2025. So the difficulty here is it's new plans after Secure 2.0. So if somebody started a plan this year, they would still be a new plan requiring automatic enrollment by January 1st, 2025. So there's a weird kind of timing element to this. And the other piece of kind of nuance to this is what constitutes a new plan. So obviously, if someone forms a business and starts a retirement plan, pretty clear. But there were a lot of questions about mergers and acquisitions and what constitutes a new plan coming out of that. Some of the trade and industry groups had asked for clarification. One of the running themes throughout this is that we'll see that we expect additional guidance on some of these provisions, especially some of the provisions that have a delayed effective date, essentially. There is a little bit of a planning opportunity here. And one of the things that we saw was, especially coming out of M&A, the thought process might be slightly different than it would have been prior to Secure 2.0. So something to be mindful of. If there's a plan in place, it's not going to be as impactful, but always something to have in the back of the mind. With that, I'll turn it over to Patrick for everybody's favorite about catch-up contributions.
Thanks, Michael. So catch-up contributions. Obviously, catch-up contributions today are those contributions that are allowed for employees who are age 50 by the end of the year. So for 2023, if you are not age 50 by the end of the year, you can make $22,500 in pre-tax and Roth contributions, or a combination thereof. If you are over age 50, in addition to that $22,500, you can also make $7,500 in catch-up contributions. The idea of catch-up contributions generally is that they allow for employees who are closer to retirement to catch up if they might be a bit behind on their own retirement savings. And so what the plan sponsor focus number 3 here is talking about is 2 different changes that were made to catch-up contribution. The first change is participant friendly. It increases the amount of catch-up contributions to between age 60 and 63. So that's actually that second bullet, second sub-bullet there. We used to talk about the other piece first, which is the required Roth treatment of catch-up contributions for certain employees, because that was originally scheduled to be implemented and effective 1/1/24. But as I mentioned earlier, back in August, that was delayed 2 years until 2026. So right now, what we want to focus on is that there are increased rates, or there will be permissibly increased rates for individuals who are age 60 to 63, starting 1/1/2025. That rate, if we want to kind of jump to the next slide, is the greater of, and now I'm looking at the middle box on the left-hand side. The increased rate for age 60 to 63 is the greater of $10,000 or 150% of the standard catch-up limit. Well, 150% of $7,500 is already more than $10,000. Therefore, the increased rate for ages 60 to 63 would be 150% of the standard limit. So that's still going to be $7,500 in 2024, and we'd expect it to increase in 2025. So again, what we want to look at there is how we identify those employees who are age 60 to 63 in 2025, and then having not the normal $7,500 catch-up rate for that group, but an increased rate of 150% of whatever that amount is. So if it changes to $8,000 in 2025, the standard rate would be $8,000. The increased rate for ages 60 to 63 would be $12,000, or 150% of $8,000. One thing to note is that the increased rate is optional. employers don't have to allow for those individuals to have the increased catch-up election. But on this one, I have a feeling that plan sponsors are going to start hearing from employees late next year that they do want to take advantage of this. So even though this is optional, I would expect employers to want to be ready for it, because there is going to be pressure for them to allow for this inside their plans. Of a lesser concern these days, now I'm going back up to the top boxes, the Roth treatment of certain catch-up contributions. Effective in 2026, if an employee made $145,000 in the prior year, any catch-up contributions they make in the current year need to be made on a Roth basis. Personal opinion on this is that this is just a budgeting game. They were trying to keep the cost of the overall Secure 2.0 legislation lower. So by forcing these catch-up contributions to be made on a Roth basis, they're accelerating the taxability of those contributions, or not allowing for the normal deferral that we have today. And so they're paying for the legislation in some degree. Again, I think it's a budgeting play. The unfortunate consequences is that we are all going to have to deal with this. I've said since the day I saw the delay from the IRS, nobody's going to worry about this until Q2, Q3, Q4 of 2025. We have a lot of time between now and then, so I wouldn't put too much stock in this until then. The record keepers are not going to care about it. The payroll providers are not going to care about it. Just focus on those things that you need to do today, rather than trying to worry about being ready for 2026. Of course, that doesn't mean that you should just ignore it forever and hope it goes away. You should be ready for it, but let's think about when would it make sense to actually implement that process, and then start along that timeline. There are some changes for some of the small employers with SIMPLs and SEPs. Those are outside the context of a 401k or qualified plan. I'm happy to talk through those if anyone has questions. Otherwise, I think that's all we have in the catch-up contribution realm.
Absolutely. And we're up for polling question number 2. All right, and this one, we've started to kind of touch on the distinction between optional and mandatory provisions of Secure 2.0. So just trying to gauge yes or no, whether there has been any adoption of the optional provisions of Secure 2.0. No wrong answer on this one.
And again, just want to make sure that everyone has a chance to get their CPE credit. There's a few people that still waiting to come in. Thank you. Just a few more probably to make sure that you get what you need. Coming up on almost everybody in. I think we'll go ahead and close this and share the results. So 42% said yes, 58% say no.
Which, I mean, pretty even split there. So I will relaunch.
Okay, there we go.
All right. And so speaking of one of the optional provisions, I don't know, Patrick, if you want to touch on the employer matching on student loans. I think you have good perspective on this one.
Yeah, so employer matching on student loans. So for those of you that aren't necessarily familiar with the issue here, it's pretty straightforward. The idea is that historically in 401k plans, when you are calculating a matching contribution, the only thing you have been able to take into account are employee deferrals and contributions to the 401k plan, whether they be Roth, after tax, pre-tax, whatever it may be. When you're looking at how you calculate the match, you look at that and that's it. You're not allowed to look at anything else. And the reason for that was what is called the contingent deferral rule. which was just a rule that says no plan contributions or other contributions can be dependent on anything but those deferrals. So you can't give incentives to defer or to not defer. And so what happened is that we've all heard about the student loan issues and that we're going to have in society. People have more and more student loans, and paying off those student loans is difficult. It's a lot of money. I say all this from personal experience. So trying to make sure that you can pay off your student loans and save for retirement is incredibly important. The idea with the employer match on student loans was that if we can allow student loan repayments to be considered when calculating matching contributions into a 401k plan, employers can deliver a retirement benefit for those employees who are paying student loans but cannot make 401k contributions because they don't have enough, disposable income to do so as a result of the student loans. Back in 2018, we had the Abbott Laboratories private letter ruling. Abbott Laboratories had essentially gone to the IRS and asked for a ruling specific to them and their plan that said they're going to make contributions to the plan somewhat on the basis of student loans. If you would have asked me 5 or 10 years ago, I guess 10 years ago, whether it would be permissible under the contingent deferral rule, my answer would have been no. You can't do that. It just doesn't work. You can kind of design around it and try to get something close, but you'd have all these limitations. The IRS came out after Abbott Labs asked for the ruling and said, yeah, you can do that. We believe that doesn't violate the contingent benefit rule. When I read that PLR back then, I remember thinking that the IRS was doing everything they could to justify this on behalf of Abbott Labs. It would have been a far easier argument to make that this was not permissible. So they bent over backwards to allow it. So the problem with a PLR is that only the group that submits the request for the private letter ruling is allowed to rely on it. So Abbott Labs was allowed to rely on it, but nobody else was. So here comes Secure 2.0 and says, actually, we're going to let everyone do this. So fantastic. I think it's in theory a great idea. My issue is this. Even before Abbott Labs PLR was released, I was actually working on a project that was very similar to what Abbott Labs was doing. And we were thinking about it. We were being a little bit more conservative in how the design was going to occur in relation to the contingent deferral rule and the current state of the Internal Revenue Code and regulations. But my client was easily able to get comfortable with the risk with the plan design we had. What my client could not get past and ultimately torpedoed the entire project was the fact that it was going to increase costs because employees were getting something that they in the future based on the plan design we were looking at versus what they were getting today. In other words, if you give a match on student loans to those people and they're not getting it today, you are increasing your costs. So whenever I'm having these conversations with my clients, I always bring up the fact right off the bat, and it almost always stops the conversation. We have kind of 3 options. One, we can increase the cost of our total compensation structure for our employees. And to do so, we would allocate those extra dollars to the student loan match. That's option 1. If they have the dollars to do so, it works out great. If they don't have the dollars to do so, we are going to hit a roadblock very quickly. That being said, a lot of clients don't want to do that. So then we have option 2, which is if we want to do this, but we don't have to increase cost, we have to decrease the benefit being provided to other employees in some way to pay for this additional cost for the employees who would receive the student loan match. If that is the case, my clients say, we don't want to cut other employees back. Okay, we don't want to increase costs, nor do we want to cut employees back. If you don't do one of those things, then your option is not to implement this. And that's how it usually goes. I talk to my clients, do you have extra dollars to fund this? No. Are you willing to cut other employees back to keep costs level and not increase them? No. Then there's not really a way to do this. So when you're thinking about this, I always encourage my clients, think about how you're going to pay for it before you start to worry about how to implement it or what the plan design would be. If you can't pay for it, don't worry about it. That goes forward. You know, there's going to be some complexity to this, and as you can see with the bottom of the slide, we put some of those questions that we like to ask when we talk about complexity. So if you do have a way to pay for it, the next kind of set of kind of roadblocks or hurdles that we need to clear are, would the amounts or the repayments be tracked in payroll, or is this going to be a manual process? If it's a manual process, what processes will be used to avoid calculation errors? So just like any other retirement plan contribution, you want to make sure you have a strong process to calculate contributions and make sure that everything's accurate. And then finally, what internal processes will be required to track student loan repayment amounts so substantiation can be provided for annual audits, et cetera. You can rely on some attestations from your employees. I don't know that a lot of my clients will want to do that because that'll be a real easy way for people to get the match without having to defer. But if you're going to do it, you know, what is your process going to look like? So really, like I said, it comes down to two kind of different areas. One, can you pay for it? Two, if you can pay for it, what is going to be the process for calculating this? What is it going to look like, and how are you going to make sure you have substantiation?
It's one of those that sounds great in practice and as it's being proposed, and then once you get to it, it's less useful, but it'll be interesting to see where that one goes. The next one that we had for plan sponsors, companies to be focusing on is the Roth treatment of employer contributions. This one, I would say among practitioners, and I believe among plan sponsors as well, so far hasn't gotten any traction. The idea here is, so there's different contribution types. So there's pre-tax contributions and Roth. And I mean, depending on people's situation, one may be a little bit more beneficial than the other. And so the idea here was, okay, let's have the availability of Roth treatment for both types of contribution, or for matching contributions, employer contributions. Similar to what Patrick was talking about, Roth being a little bit of a budget aspect, or kind of a consideration of pay for in the legislation. This one also kind of pops up in the same way. It's something that, as the legislation was being proposed, they could essentially assume a certain amount of Roth contributions, Roth employer contributions. I think some people were talking that even the legislators didn't think that this would get a lot of traction up front. And part of the reason why it's a little bit tricky is that the FICA taxes and the taxation on these contributions. So pre-tax treatment, you don't have to worry about it here. They will be taxed when they are distributed or withdrawn. Here, there's going to be taxation up front, and then the idea is that it grows and is distributed tax-free. But in the case of an employer contribution, it's not as clear how to set that up for taxation. And so we've outlined here some of the complexities behind this that are almost making this one dead on arrival for most plan sponsors. So how are they going to be tracked in the payroll system, record keeping system, both systems? And then the other thing that makes this one unique is currently, before Secure 2.0, the employer matching contributions were all treated the same way, essentially. Now it would almost be like an employee election. Do I want it to be treated as Roth? Do I want it to be treated as a pre-tax contribution? And so that adds complexities. It's not entirely clear whether you would have to offer that or whether you could just mandate Roth treatment or some sort of combination of both. And then the other piece of it is just how the calculations are being performed, preventing any sort of double counting issues. Again, this is one across the industry that as we talk to plan sponsors, even if there's interest in it, like, oh, that'd be a good idea, the lack of guidance on the taxation piece of it and just how this is going to mechanically work has really shut this one down. I don't know, Patrick, I think I know your opinions on this, but as we've been approaching it, we've been telling employers to kind of pump the brakes, wait for other people to figure out how this might work, wait for guidance. But Patrick, I don't know if there's anything else that you've seen or run into on this one.
Yeah, on this, I think everybody that talks to me knows my opinion on it. I think this is just another budget game that was being played by allowing the Roth treatment. The Congress and the Budget Office were allowed to take into account certain assumptions on utilization by employees. And that assumption on utilization would translate into current taxation rather than deferred taxation, which would accelerate taxation and revenues, which paid for the bill. So I don't think this one, I'm recommending to my clients very strongly, do not consider this one. Apart from the tax treatment, which I was talking to somebody this week, and I guess they're looking at whether this could be, the taxation could be captured in a 1099, which would be the natural way to do it. The big question is whether their IRS and Treasury have the authority to put it into the 1099 tax reporting rather than the W-2. If it's in the W-2, it's going to cause all kinds of complexity there and new issues with the payroll reporting companies. So again, I'm telling my clients not to do it. If they have employees that really want this, I always tell them to look at two things. One, is this employee already maxing out their Roth deferral, the Roth contributions? If they're already deferring on a pre-tax basis, but they're not maxing out on a Roth basis, then you can accomplish the exact same goal by making your employee contributions Roth rather than doing it through employer contributions. You know, problem solved. It's an education issue. Number two, if you want to do this, we already have a way to do it. In-plan Roth conversions. If you want to do it, look at whether you want to, whether there's an ability within the plan to offer those in-plan Roth and go that route. So, you know, I get it from a participant perspective. They may want to accelerate the taxation because they believe rates will be higher in the future, this, that, and the other. I would just say that we have other ways of accomplishing the same goal. So why wouldn't we try to do that rather than try to force a square peg through a round hole on this thing and try to push it before we have all of the guidance? I would quite frankly be terrified of it as an employer, and I would do everything in my power to avoid allowing it in my plan. So that's my opinion, Michael, assuming it's not surprising, assuming it's still opinionated.
No, I I was chuckling earlier. You led with like, this is my opinion or something like that. It's like, ooh, it's gonna get juicy here, but it was something that I knew already. So the other thing you touched on, the availability of the in-plan raw conversions, is a plan feature, and the one thing that we already see is that's not especially utilized in plans that have it. So it's something that all of this kind of has a lack of education. So you can get to the same route in multiple ways, and people already aren't doing that, I guess. The next item we had here is IRS correction program. And the one thing, so 401k plans, employer plans are qualified plans by design. So there's tax benefits, assuming the qualifications are met on the employer and the employee side. So it's a very tax advantageous position to be a qualified plan. But we know that there are some complexities around the administration of these plans. I mean, our day job is a lot of correcting issues that have come up within a qualified plan, so qualification, operational failures. And the IRS for many years had a program by which you can correct those. I'll say generally voluntarily. It can come in a few different forms, but there are ways to maintain qualification even if you've had some sort of a qualification failure. So without that program, it would be a little bit more black and white, that if there was a qualification failure, then you are disqualified, and all the negative impacts that come with that. IRS, recognizing the complexity around this, has instituted the program. And what they've really been pushing, and we've seen this across regulatory agencies, but this is IRS specific, there's more of a focus on trying to get plan sponsors, employers, to actually self-correct. So self-identify the issue and then take the steps necessary to correct it. And so with that in mind, part of Secure 2.0, so this is legislative, not just the IRS, but the idea within Secure 2.0 was to expand the self-correction program. And one thing it's a little debatable. We have drastically, and they were selling it as a drastic expansion of self-correction within the revenue procedure that allows it. And the more we dig into it, and there was some kind of interim guidance on this, it's not a full-blown, any type of an issue can be self-corrected. There are still kind of guidelines and bounds around it, but there is this increased focus and this increased emphasis on trying to get plan sponsors to correct. And the one thing that probably is a good step back is the distinction between self-correction, which is one of the kind of correction methodologies or correction programs within the IRS correction guidance, and the voluntary correction program. And one, you're actually filing a submission with the IRS, and in the end, you get a compliance statement that says, we've reviewed this issue. I mean, in the end, if you're successful, the IRS issues this compliance statement that says, we've reviewed it, we understand it, and you've taken corrective action on this. And so there's, we deem this to be appropriately corrected. The self-correction program does not provide that kind of security blanket that the voluntary correction program, or VCP, provides. And so even going back to pre-Secure 2.0, we had clients that probably could have self-corrected but given the nature of the kind of issue and the assurance provided, opted this self-correction route because of the assurance provided. Now with some more expansion, maybe we see a little bit more going this route. There have been some prior to Secure 2.0 that already allowed for more expansive self-correction. It's just something to keep an eye on. The VCP program is actually fairly backlogged, so if you need a quick answer, you won't really have an answer, but if you need something quick, self-correction might be the route to go. But I don't know, Patrick, if you've seen any other kind of trends in this direction. I would say I haven't seen a huge shift, even though this was being sold as this big blowout from the perspective of Secure 2.0.
Yeah, I don't think I've seen any big shifts here. I think people were thinking it was going to be a big shift. Ultimately, though, Michael, like you said, a lot of our clients, and this might be because of the kind of clients we tend to get, are already risk averse in some way already, so they want to go through VCP. I would see it as a lot bigger change if they narrowed down VCP than expanding the SCP, just because I usually don't have conversations with clients really about what, if there's any ambiguity as to whether a client is eligible for SCP, they go VCP.
All right, moving on to the third polling question. Getting relatively close to time, so want to move relatively quickly so that a few questions can be raised. This third one, just trying to get a sense for size. What I would say for those responsible for administering plans, there's complexities at all levels. So we have 100 to 200 participants, 200 to 500, 500 plus, knowing that some of you all have Richie May audit, that tends to indicate that there might be more than 100 participants there, but just trying to get a sense there.
Okay, it looks like we have just about everybody in. I'm going to close this poll and share the responses. 41% have 100 to 200, 41% also have 200 to 500, and 18% have 500 plus.
All right. Close me out. We're back.
There we go.
So next steps and considerations. Patrick, I don't know if you want to just briefly touch. We kind of talked.
I'll keep it pretty brief here. We need a lot of guidance on all this stuff. As you can see on this last bullet, we've been hearing that a grab bag of guidance is coming soon. I haven't seen that. I talked to somebody this week that is very connected to Treasury, was previously at Treasury working on this stuff, and he has been hearing that as well. Keep begging for it, considering a lot of this stuff is going to be implemented and effective in 1/1/2024. We don't have it though, so keep your eye out. Some guidance has been kind of dripped out, but I think it'll keep coming out, and we'll keep hearing about it. So finally, as far as like a strategic approach to these changes, I would just say that with everything going on with these plans, now might be a good time to think about, okay, are we going to look at the long-term part-time stuff in a vacuum, or are we going to look at it in conjunction with our overall eligibility conditions? I think you should do it in conjunction with everything. So if you're going to make a change, think about whether it makes sense to make the statutory change now and some other change 6 or 8 months down the road. I don't think that makes sense. So, it is what it is. Just look at it, see what other changes you need to do, and get them all done at once. Make sure you're staying in contact with your internal and external providers. That's Richie May, that's your record keeper, that's your investment advisor. We all have our eye on this, so everybody can help you. Don't think you're in this alone. They should be able to provide you guidance on any questions you have. In all likelihood, you're not the first one to ask the question. We've been getting questions every single day. we're all worried about the same thing. So just let us know, or your service providers know, and they can get it. So finally, think about what's optional versus required. At this point, my advice to all my clients is make sure you're ready for the required changes. That's kind of a given. And be very deliberate about any of those optional changes you want to make. Don't try to boil the ocean with this thing. We already all have enough on our plates with everything going on in the world. So be deliberate if you are going to implement anything on an optional basis. So that's the end of our presentation. We do have one more poll question. Do we want to run through that? And then I think, Katie, if you want to kind of close us out or talk about any questions, that'd be great.
So our last poll question is in. Are you ready to deal with all of the mandatory provisions? Not at all, or bring it on. We have about half the group already in. Oh, we're going fast. Just if I can get a few more people, get your votes in. That looks like it's just about everyone. That was super fast on that one. And here, whoops, here are the results. 56% said not at all. 44% said bring it on.
Get a kick because we don't give a ton of flexibility. It's all one or the other. So definitely some middle ground there. But we have just a few minutes and close for any questions that may have popped up. And obviously, if there are questions that don't come up in the moment, we're available and happy to talk through this. You see, we're both fairly excited about it. So.
Thank you both. One question that came up is, which of the new provisions are the most popular among the plan sponsors that you've been working with? What have they kind of asked the most about or seem to be wanting to adopt?
Long-term part-time, the increased cash out limits, and then catch-up. Those are really them.
Yeah,
long-term part-time is required, but it's really about whether to put in the requirement or, like Michael was describing earlier, just go with an immediate eligibility. There are pretty big advantages to both approaches, so that's a big one.
Yeah, I was just going to echo the cash outs. It's not one that we spend time on, but it just allows for distribution of participant accounts up to $7,000.
Okay, and it looks like we have time maybe for one more question. What are you seeing for vendors? Which vendor category has the biggest lift right now? The payroll providers, the record keepers, the consultants, the legal counsel? I know you guys do legal too.
Record keepers. Today it's record keepers. Before, with the Roth catch-up stuff, it was going to be the payroll providers and how to switch that over and how to do the reporting and all that kind of stuff. But since they delayed that, it's the record keepers. And the record keepers have been dedicating millions of dollars to this each. I know some folks at each of the big record keepers, and they've all been having consistent messages that they have teams dedicated to this.
Great. I think we have time. Do we want to do one more question before we wrap up?
We can keep going.
You touched a little bit on this, Patrick, as you're kind of going through of what provisions raise the most concerns from a compliance standpoint, but is there any one big one that they should really watch out for?
I think that the long-term part-time one, if you don't go with some other approach, could have some significant impacts. I mean, we've seen lots of clients that have trouble counting hours over the course of the 1 year because they have seasonal employees or whatever it may be. I mean, Katie, you're smiling. I mean, it comes up every time. Hours comes up all the time. And now we've said, okay, you're having trouble counting to 1,000 in 1 year because of all these crazy circumstances employees have, right? And they're like, we get it that you have a problem. Now we're going to say, don't worry about 1 year. Worry about 3 years and 1 year. Oh, and by the way, we're going to change the 3 to 2 in another year. So it's, to me, that one is going to be incredibly confusing over the next 3 to 4 years for people, and it's just going to be a compliance issue.
Thank you both for sharing all your knowledge with us. Again, if more questions come up, you can reach out to myself or Michael or Patrick. Thank you all for attending our webinar.
Thank you for having us. Thank you, everybody.